You think a corporate crisis is a tragedy to avoid. You watch the news, see a public health panic wipe out half of a $20 billion market cap in a matter of months, and you assume the company is dying. But at the 9-figure level, that blood in the water is the exact entry point you use to seize board control and mathematically force a multi-billion-dollar return. While retail investors panic sold Chipotle in 2016 over a cascade of food safety scandals, Bill Ackman used a $1.2 billion position to weaponize the boardroom and execute buybacks at the absolute bottom. This is the misconception that keeps you poor. The amateur belief that you buy distressed assets and wait patiently for management to fix them. The amateur buys shares and prays. The predator buys enough equity to hold management hostage, replace the CEO, and force the balance sheet to cannibalize its own cheap shares. You are going to master the activist capital allocation playbook today. You will learn how to use a minority equity stake during a catastrophic PR crisis to seize board seats. You will learn how to decapitate underperforming leadership and mandate aggressive share repurchases that multiply your equity value before the public realizes the bleeding has stopped. Step 1. Never buy a falling knife without a mechanism to stop the bleeding. In 2015 and 2016, Chipotle faced a catastrophic series of E. coli and norovirus outbreaks. The stock, which had been flying high, went into freefall. Revenues plummeted, customers abandoned the stores. The media was running a daily death watch on the brand. Most investors looked at the chart and saw a toxic asset. Bill Ackman's hedge fund, Pershing Square, looked at the balance sheet and saw an unlevered cash machine temporarily impaired by bad management. But Ackman did not just buy the dip and hope the founder figured it out. He engineered a chokehold. Pershing Square acquired a 9.9% stake in the company for roughly $1.2 billion at an average price of around $405 per share. Why exactly 9.9%? Because in the corporate world, 10% is the tripwire. Cross 10% and you trigger a poison pill, a defensive corporate tactic where the board floods the market with new shares to dilute the hostile investor to nothing. You also trigger severe SEC insider trading restrictions. Ackman parked precisely at 9.9%, the absolute maximum leverage without triggering the corporate defenses. With that stake, he approached the terrified incumbent board. The stock was in freefall, the media was savage, the board was vulnerable. Ackman didn't ask for a seat at the table. He threatened to proxy fight a campaign to convince all the other shareholders to vote out the current board and install his people. A proxy fight is expensive, public, and brutal. The incumbent board, terrified of a public war while the stock was already cratering, capitulated. They handed Ackman 2 board seats without him having to spend a single dollar on a full hostile takeover. He now had direct access to the internal capital allocation levers. He bought leverage, not just equity. This brings us to your precise psychological defect, the builder trap. You are a brilliant, self-taught builder. You ship world-class systems alone and fast, but your fortune is blocked because you perfect products instead of selling them. You start new systems instead of finishing the money loop on the last one. You chase better tools when the bottleneck is distribution and closing real deals with real people. You avoid the human conversations that actually pay. You think the code is the business. Listen to me, a depressed stock price is useless if the market does not believe in the operator. Step 2. Decapitate the visionary. Chipotle was built by its founder, Steve Ells. He was a classically trained chef. He was obsessed with ingredients. He was just like you, a pure builder. He cared about sustainably raised pork and organic cilantro, but he had no idea how to navigate a catastrophic PR crisis or optimize the digital scale of the business. Ackman used his newly weaponized board seats in late 2017 to ruthlessly force out the founder who built the empire. Visionaries build companies, mechanics scale them. In early 2018, Ackman's board poached Brian Niccol, the CEO of Taco Bell. Niccol was not a visionary chef. He was an executioner who understood distribution. He understood unit economics, the direct profit and loss of a single store. Niccol did not invent new food. He implemented drive-thrus called Chipotle and completely overhauled the digital ordering systems. He focused on the machine, not the ingredients, and within 18 months, digital sales margins exploded by 27%. He fundamentally altered the margin structure, the profit left over after paying for the burritos and labor, while the stock was still priced for bankruptcy. This is exactly what happens to you if you cannot evolve past the builder trap. Capital will come in, look at your beautiful product, decide you lack the killer instinct to distribute it, and replace you with an operator. Once Ackman controlled the board and the operator was fixed, he moved to step 3. Step 3, weaponize the balance sheet. Ackman mandated aggressive share repurchases at crisis multiples. He forced Chipotle to buy back millions of its own shares, while retail investors were still terrified of food poisoning. Between 2017 and 2021, the board authorized over $2 billion for share repurchases. Let me explain exactly how a buyback forces a wealth transfer, because beginners fundamentally misunderstand this mechanic. A buyback is when a company uses its own cash to buy its own shares from the public market and destroy them. This shrinks the float, the total number of shares available. If a pie is cut into 10 slices and you own one, you own 10%. If the baker buys back 5 slices and throws them away, your single slice is now 20% of the pie. You did not spend $1, but your ownership doubled. This drives up EPS, earnings per share, the company's total profit divided by the number of shares. It is the primary metric Wall Street uses to value a stock. Ackman forced the buybacks when the stock was bleeding at $300 to $400 a share. He concentrated Pershing Square's ownership percentage while the stock was cheap. When the public finally realized Brian Niccol had fixed the unit economics and revenue returned, the EPS mathematically exploded because there were far fewer shares to divide the profits by. By 2024, before Chipotle's 54-1 stock split, the price broke $3,200 a share. As of 2026, this remains one of the most violent wealth transfers from panicked retail investors to calculated activists in modern history. But none of this mechanical brilliance works if you do not have the character to execute it. Emotional control under pressure and strategic silence are mandatory. When the media is screaming about norovirus and analysts are projecting zero growth, the amateur defends his position on Twitter or panics and sells. The billionaire stays dead silent in the press. He negotiates severance agreements in the boardroom. You do not need to be liked by the founder you are replacing. Steve Ells built the company. Ackman fired him anyway. You need to protect your capital and force the mathematical outcome. Empathy in the boardroom costs you 9 figures. If you cannot look a visionary in the eye and tell him his time is up, you have no business deploying capital at this level. This brings me to your assignment. I know the excuse you are already making. I don't have $1.2 billion to buy 9.9% of a public company, so activist investing doesn't apply to my current level. Wrong, the mechanics of leverage scale perfectly down to the middle market. Identify one publicly traded company or local mid-market business doing $10 to $50 million in revenue that is currently experiencing a temporary, non-fatal PR or macro crisis. By Friday at 5 p.m., map its cap table. A cap table is simply the ledger of who owns what percentage of the company. Identify the exact leverage point. Is it a debt covenant breach, an exhausted founder, an activist threshold they haven't noticed? Then write a one-page term sheet, a non-binding offer document on how you would structure a minority investment. Make sure your term sheet includes mandatory financial controls, a board seat, and veto rights on all capital expenditures. Do not watch the next video until this is done. If you cannot structure the hostile takeover of a $10 million local distributor on paper, you will never do it for $1 billion. You don't buy equity to participate in the future, you buy leverage to dictate it.